Welcome from me, Guy Monson, to our regular 6-minute strategy. Global equities have rebounded sharply since Trump's Liberation Day on April 2nd, driven by earnings that, despite tariff risks, have broadly exceeded expectations. US profits are now running 8% ahead of forecasts, with sales nearly 2% ahead. European earnings also surprised on the upside. The rally has been led by cyclicals, industrials, banks and other riskier sectors. Quality stocks with steadier earnings and stronger balance sheets have lagged. This has been challenging for investors with strongly thematic, quality-rich portfolios, but we believe such positioning remains right for the long term. 3 reasons stand out. First, the US economy is cooling, employment growth is slowing, and business surveys are softening, which will weigh on earnings. Second, tariffs are starting to bite, with US factory gate prices and service sector costs moving higher. Third, valuations look stretched and some markets appear frothy, fueled by retail speculation, surging option activity and record margin debt. This is not yet the time to cut overall equity exposure, but it is the time to focus on quality. In short, resilience is worth the price today, as we'll discuss in the slides ahead. So in the left-hand panel, I've shown the performance of global equities since those April 2nd Liberation Day lows, rising strongly. Now it's interesting that blue line is above the red line, which is the quality index, which focuses on companies with high returns on equities, stable year-on-year earnings growth, and lower financial leverage. So in other words, this is a relatively low-quality rally led by banks and deep cyclicals. On the right-hand panel, you can see what this has done is brought down the relative valuation of quality names relative to the wider index. So we think this is a good point in the market cycle to begin to build up more resilient stock positions and emphasize those quality numbers across your portfolio. Looking at other assets on the next slide, you can see that US Treasury yield is about 4.3%, really flatlining, with US bond market volatility falling sharply, a Treasury bond market that's really becalmed. On the right-hand index, you can see a similar factor for the dollar. Yes, we saw a sharp 10% fall of the dollar in the first few months of the year, but for the last 2 or 3 months, the numbers have been broadly flat. Crude oil also beginning to show weakness as again the OPEC continues to increase production into a probably softer US demand picture. Where does all this leave the president's tariff agenda and his MAGA policies? An average effective tariff rate looks to be around 17.5% for the US. That'll raise significant revenue. Now you can see in that left-hand panel the monthly collections at $30 billion for customs duties continuing to rise sharply. We think for full year 2026, tariffs could generate in excess of $500 billion a year for the US administration. And that's very helpful in bearing down on those fiscal deficits. And indeed, Standard & Poor's, who this week reaffirmed the US's AA+ credit rating, saying we expect meaningful tariff revenues to generally offset weaker fiscal outcomes. So for Trump, the tariffs are yes a trade tool, but they're also a revenue tool. Let's have a quick snapshot of the US economy here to see where we're standing. On the labour market on the left-hand panel, things have definitely softened, but we're not at any sort of crisis level. Job openings are about 7.4 million, still just exceed the unemployment number at 7.2 million. Where we've got more worries is in the forward-looking surveys. This is the famous ISM Services Index. At 50.1, 50 marks the difference between contraction and expansion. The economy is fragile, the services economy. But look also what's happening to prices paid, that red line rising really sharply, beginning in my view to suggest there are some tariff increases coming down the pipe. Now we also saw a relatively benign US CPI number, but we saw a very strong US PPI number, that's factory gate prices. So my feeling and our feeling here at Saracen is that tariff impact will begin to bite in the fourth quarter and first quarter next year. In the UK too, we've seen higher inflation prints this week at around about 3.8% for the core and headline numbers. Now there's some excuses. Air travel was particularly expensive over the last 12 months, and we saw a big move up in other holidays and travel. But the number, of course, at 3.8 was broadly in line with the Bank of England, but it is a high, sticky number, and that's putting pressure on the gilt market, which is trading now well above the 10-year yields that we saw even at the peak of the Liz Truss debacle. The wider UK economy is actually performing quite well, with real wage growth strong and the US composite PMI beginning to rise well above that 50 number. Now yes, some of this is government generated, but it does bode well for perhaps a slightly less gloomy backdrop to Reeves's budget later in the year. What does all this mean for interest rates? We still expect 2 further cuts in the US, with a 25 basis point cut at the December 16th, 17th meeting. Now, of course, Chairman Powell at Jackson Hole making his keynote speech this week may say something very different, but I think that's probably where we lie. Treasury Secretary Scott Bessent, who shouldn't really comment on monetary policy, going in there with the Trump agenda and saying we need a giant 50 basis point cut in September. We're still expecting with our 225s. For the Bank of England, they're in dark blue. The market flip-flopping between one more cut and staying where we are. We personally think with that 4 votes dissenting from the last cut and with that bad inflation number, the Bank of England probably holds steady through to year end. So let's wrap this all up. Global equity numbers still are impressive in terms of forward earnings growth at around about 13%, with monthly revisions drifting positive and share buybacks strong. But there are some signs of concern. Valuations are high. I've shown there in the right-hand panel the equity risk premium. That's the additional premium you get for investing in equities over bonds, at its almost lowest level since the bubble period of the 99-2000 tech rally. So what does this mean for markets overall? It means some caution, not in the equity holdings you have, we're neutral, but in that emphasis on quality and resilience, which we think is important at this point in the cycle. We're underweight bonds, still a bit nervous of those inflationary pressures, and within our alternatives, we're still holding our overweight gold position. So I hope this is helpful. I hope it shows a route to building in some investment resilience at this rather frothy point in global equity markets, and this can be part of your asset allocation and portfolio strategy in the months ahead. Thank you.